All right, everyone. Well, thank you for joining this afternoon. Calling in from snowy Chicago. It's actually sunny right now, but we've got a good 3, 4 inches of snow on the ground. So was doing some snow shoveling this morning, so got my exercise, and we'll just kill some time here as we wait for all the participants to log in. But I have a lot to talk about today, and belated Happy New Year to everybody. And thanks for joining us before the long weekend, President's Day weekend. Hopefully you guys have some good plans in store for you and yours truly and your families. But very excited to be doing this first rendition of Hedged with a Capital D. This is the almost, we used to say almost monthly, but it's really almost quarterly kind of public presentation we do. And today we're going to be talking about our market outlook and some investment themes we're excited about. I'm usually joined by my partner in crime, Mark Yusko, but he's off gallivanting around the world right now. As of last check, he was in Hong Kong. Should be back next week. But that actually ties in nicely with one of our themes we're going to be talking about, which is the Chinese recovery and opportunities within. So we're going to first start off with the market outlook, then talk about some of those themes. Four themes really we're going to be honing in on today: innovative healthcare, Chinese recovery plays, rifle shot shorts, and artificial intelligence. We're going to save that one for last, just to make sure everybody stays on the line here. So as always, we're going to be keeping things at a pretty high level in this forum, just to be respectful of time and also given the forum. But if you would really like to dig deeper on any topic or just to catch up with me in general, please don't hesitate to reach out. So with that, let's advance some slides here. Here are the important disclosures. Previous webinar topics, like I said, we'd like to do this, once a quarter. And if you didn't catch the last one back in September with John Yetimoglu of Infinitum Partners, I would really encourage you to listen to that one. He is a new partner of Morgan Creek's, and we really like how he thinks and invests. And he really is an expert in one of the dominating themes in the marketplace today, that being AI. So I'm going to share some thoughts on it a little later in the presentation, but he really is a true expert in that field. So if you haven't listened to that webinar, would highly suggest doing so. So without further ado, going to the market outlook. Really like this slide, but whoever put it together should be shot, or I should be better at snipping because it's a little blurry, but the data is good. So bear with me. And basically it says that after 2 straight 20% plus years, returns the next 2 years are mixed. So if you look at the data here, if you look at 1995, so 1995 is the light gray bar. If you look at 95 and 96, these are 2 very strong years, and they were followed by 2 more very strong years, up over 20%. Also in 1924 and 25, so the brown bar here, you can see that 2 20% plus years were followed by equally strong years, not quite 20% plus years, but one 10% year and one over 20% plus year. But if you look at the other 7 occurrences, so 1, 2, 3, 4, 5, 6, 7, this one hasn't happened yet. So other 7 occurrences, you can see the returns, looking at the average. So the pink bars were well below historical norms after those 2 big 20% plus years. So you can see here a low single digit year, and then a mid to high single digit year. And if you took out the 1990s and 1920s, outliers, those average returns would be less. So, what do we think? Will 2025 and 2026, after 2 up 20% plus years in 23 and 24, be like 1997 and 1998, or 1996 and 1927, or something, more average? But however you think the next 2 years are going to turn out, investors should probably start to at least think about layering in some hedges into their portfolios, because we all know what happened or followed after the 1990s and 1920s. Answer being the tech bubble and Great Depression. So whatever the case may be, as an investor, you don't want to stay at the party too late. And, if the saying nothing good happens after midnight is true for parties, as I get older, I think the saying is actually nothing good happens after 9 p.m. But I think the actual saying is midnight. I think the equivalent for markets might be sometimes good things happen after 2 straight 20% plus years. But if something good does happen, then come 2 or 3 o'clock in the morning, the wheels completely fall off. So you don't want to be completely exposed when that happens, even if it's the best party you've ever been to. So with that backdrop, leaning on the wisdom of others, in this case, Supreme Court Justice Louis Brandeis, sunlight is said to be the best of disinfectants. Back in October of 23 and again in April of 24, in those webinars, we asked if long-short equity was back. And we said that, sunlight in the form of higher interest rates would be the best disinfectant for a lot of the excesses being built up in the markets at the time, as it would expose the bad business models and shine a spotlight in a good way on the good business models, thus creating a fertile hunting ground for long-short equity managers. This is starting to play out, and it's really showing up in the performance for the asset class at large, which we'll talk about and show you a little bit later in the presentation. But the big, variable, in that thesis is interest rates. And we showed this slide before, updated it for the presentation today. But the last, really couple decades, and really following the great financial crisis, was not a normal interest rate backdrop. And we're just now getting into more normalized levels, around 4 or 5%, looking at the 10-year yield. And, if you look at, these interest rate cycles, they tend to be long. So, if you look at this chart here, it's measured in decades. But from the, 50s and 60s through the mid to late 80s, interest rates were rising. And then from, late 80s, really through only a couple years ago, interest rates were falling. So a rising tide, lifts all boats. In that multi-decade period, valuations really expanded greatly. So, following the GFC and even more so following the pandemic. But we think that interest rates are likely to stay in a more normalized range going forward, maybe even continue to inch higher going forward, as we think this cycle has pivoted in the other direction. And that's really because, inflation, it's a tough genie to get back in the bottle after it gets out. And if you look at prior inflationary cycles, there tends to be two waves. So the dark blue line here is present, and the other lines are previous inflationary periods, the 70s, the 30s, and early 1900s. And, if you look at where we are now, there's a strong inflation print yesterday. It looks like, inflation has stabilized at a lower but still high level. And, there's a risk that there's a second wave like prior cycles. And why is it a risk? Well, if you look at the Trump administration, a lot of those policies are objectively inflationary, tariffs, cracking down on immigration, tax cuts, et cetera. If you just look at, a lot of the economists' expectations of these policies likely to be inflationary. And if you look at, the market's expectation for rate cuts, especially following the strong print yesterday, the number of, and this is kind of astounding, I didn't realize it until I looked at the data, but the number of cuts this year expected has fallen to 1 in the fourth quarter versus 10 by the end of this year, as recent as last fall. So that's a big change in expectations for the rate cut cycle in only a few months. So, just looking at this chart here, which is data we showed in the July 15th, 2024 webinar, and this data is from Strategas Securities. They put together an interesting analysis that said, fear the cut, not the pause. And, what this basically means is that, if you look at, prior cycles going back to the 70s, usually after the Fed stops hiking interest rates, but before they cut, markets do okay. So on average, looking at the chart on the left, markets are up 5% over about a 100-day period. This time, the Fed stopped hiking rates in July of 2023, and their first cut was in September of 2024. So during that almost 300-day period, the market was actually up a lot more than the historical average, close to 25%. And since then, the market has continued to do okay. So this is what they mean by fear of the cut, not the pause. Because if you look at these previous cycles, on average, since the 70s, once the Fed started cutting rates over the ensuing a little over 200 days, the market was down on average 23 odd percent over 213 days. This time, interestingly, the market is hanging in there thus far. We're about 100 days since that first rate cut, and the market is up about 8%. So, the question is this analysis flawed? Will this cycle be different? Very well may be. Or are the next 100 days going to be very interesting? I don't know. We'll find out. But what is unequivocally different this cycle so far is that, earnings are hanging in there. And that's because if you look at these previous cycles, usually when the Fed starts cutting, and the Fed's usually cutting because they see economic weakness, so it makes sense that earnings would follow suit, usually earnings decline. And you can see that sometimes they decline a lot, sometimes by just a little bit. But it doesn't take much to change market perception and cause a correction. But this time so far, earnings have been really strong. And if you look at this current earnings season, earnings are coming in quite nicely. And the market is expecting earnings to continue to be strong, even Xing out the Magnificent Seven, looking into 2025 and 2026. That said, I will say, and this isn't anything all that dire, because expectations are so high, but thus far in this earnings season, even the results have been so good thus far. The 2025 estimate on a consensus basis has come down by about 1 percentage point. So nothing to be alarmed about, but obviously, earnings have not declined as was the case in prior rate cut cycles thus far, but estimates for the out years at the moment are pretty generous, or optimistic would be a better word. So, looking at old GMO, if you need a bearish outlook, look no further than GMO, but it's not just GMO. Hussman, the Buffett indicator, Shiller PE, all show equal results, and the outlook's not as bad as when stocks were about to turn over in summer 2021, but they're still ugly. So they've updated their analysis a little bit to factor in a normal interest rate environment versus a low interest rate environment. But either way you slice it in the U.S., over the next 7 years, so this is a 7-year outlook on a real basis, factoring in inflation, they think stocks in the U.S. compound at a negative number. So something to think about. Still see some opportunity outside the U.S. and in emerging market stocks and emerging market value. We agree there. We'll talk about that a little bit later as it relates to China. So slow and steady wins the race still. Not to beat a dead horse, but picking on Kathy a little bit more. I've showed this chart in the past. The math of loss is horrible. When you're down 75%, which ARK was from the peak to the trough over the course of 2021 and 2022, you got to be up 4x, right? To turn $25 into $100 or 300% just to get back to even. So even though ARK had a really strong year in 2023, even though they were up 26% in November following the election, the average hedge fund, as measured by the Bloomberg hedged equity, figure what the Q means, long biased index, has still, over this time period, beaten ARK, which I view as a growth and momentum proxy on a cumulative return basis, actually trounced ARK on a cumulative return basis, about 2x the return with much less volatility. So that was just the average hedge fund. And to my earlier point about hedge funds, really starting to perk up here. after, a really tough decade, a lot of managers did even better than the average. And, many well-known managers had great years, probably recognize a lot of these names. The multi-strats, which have really taken the hedge fund crown over the last decade in terms of flows, they did fine. But to really capture the big returns last year, you needed to be at the more concentrated long bias managers like, a Light Street or a Lone Pine, Tiger Global, going down the list. And a lot of these managers are TMT oriented. Think this will broaden out to other sectors going forward. But most importantly, stock picking, I think, is back in vogue, not just on the long side, but on the short side as well, across anecdotally kind of our manager universe. We did see a fair amount of short alpha, even in a strong year like 2024, as these higher rates are creating more dispersion amongst the good and the bad. But the tricky part can be accessing some of these managers, and that's where a firm like Morgan Creek can come into play. So looking at this data, so this is the Goldman Sachs VIP list. It's actually an ETF now, and this replicates the top hedge fund holdings across the managers that PB with Goldman. So really the titans and who's who of the industry. And you can see that, there's some good alpha on the long side last year. This is a global portfolio, up about 30%, global equities up, high teens, 20%. So, even though there was good short alpha last year, it really was the long side that drove some of those big gains that I showed on this slide. But overall, I think it's good news. I think the industry is back. And I think that returns are not just strong in 24, but also in 23 and across the board from what I've seen so far. Hedge funds are off to a good start here in 25. So, I think as long as rates, do stay in this more normalized range going forward, it's going to be an asset class you want to bet on versus long only traditional equities and indices over the next 5 to 7 years, per the GMO outlook. Some of the themes here. So talking about innovative healthcare first. And again, leaning on the wisdom of, some true, titans in the world, both past and present. Steve Jobs, said that he thought that the biggest innovations of the 21st century would be at the intersection of biology and technology. A new era is beginning. Jamie Dimon, more recently, said that your children are going to live to be 100 and not have cancer because of technology. And literally, they'll probably be working 3.5 days a week. So lucky to be my kids right now, even though I feel like the only thing they give me at the moment to have little ones is a cold, which apologies for my voice, but I don't know if it's just me or my family, but for the last couple of years of little ones, it's been one cold to the next. But good thing we're talking about healthcare. And if you look at XBI, this reminds us a lot of IGV. So XBI is the biotech ETF. IGV is the software ETF, which we talked a lot about if you listen to these webinars back in 2022. Actually really started in 2021 as a table pounded opportunity. And we think XBI looks a lot like the software ETF did at the time. And in that, it looks like a coiled spring. And you can see that really looking at the IGV here. And you can see that in late, 22, early 23, after, bottoming, in mid 22, bounced around and then really took off. And it's really amazing how quickly narratives can change in this industry, in that, we've really gone from an environment where AI was going to kill software to one where software is going to be one of the biggest beneficiaries of AI. And, we think that, the narrative for biotech and pharma and healthcare, overall, could change, quite a bit going forward versus the really negative top-down, sentiment environment we've been in for the last 4 or 5 years. And that being said, there's always a bull market somewhere, especially when innovation is involved. We've talked about one of our favorite names in the space. Before Insmed, that name was up triple digits last year despite a choppy tape in healthcare because it announced results for a breakthrough treatment in bronchiectasis. And so we think there's a lot of overlooked Insmeds out there right now that continue to innovate and that are getting no recognition from Mr. Market. Sometimes you just have to be patient and wait as investors, as frustrating as it may be. But Big Pharma continues to be flush with cash, has a license to spend, both to restock their pipelines and with the changing of the guard in Washington, likely a pickup in M&A. So really think that this chart from a technical standpoint reminds us of IGV, looks like a coiled spring. And importantly, over time, looking at the channel here, you've had higher highs, higher lows, and really going to get back into that channel to get back to previous highs. There's a lot of upside, about 90% just looking at the data here. So a lot of opportunity for investing within that 90% as we believe this sector continues to improve this year and going forward. And if you'd like a full dissertation of our thoughts on biopharma, we did a webinar back in November 30th, 2023. So be sure to check that out. And then looking at the Chinese recovery plays, whenever a theme turns into a four-letter word, it's time to roll up your sleeves and do some work, because that just means people have completely given up on it. And it's really hard to talk about China better that I'm doing this virtually versus in person, without some mean looks or stern looks or being escorted out the room, because sentiment's just so bad. And most people wouldn't even believe that China was up just as much or almost just as much as the US last year. The Hang Seng Index being up 23% versus the S&P 500 up 25%. So, we think market there is starting to recover. Again, leaning on the wisdom of some titans here, Bill Duhamel from Route One. Great returns often come from investing in out of favor situations. It's not much more out of favor at the moment than China. Be fearful when others are greedy and greedy when others are fearful. There may not be any fear in the S&P right now, as evidenced by that analysis from Strategas I showed you earlier, but there's plenty of fear as it relates to China. So, like the XBI, we think the Hang Seng also looks a lot like the IGV did back in late 2022. And, it's interesting, at the end of 2023, we got a lot of manager letters from China-focused managers saying that no major stock market had ever been down 5 years in a row. After reading that more than once, I was like, wow, this is the kiss of death. Chinese equities are definitely going down again in 2024. But sure enough, they're up. They're up. So that statement still holds true. But even so, it's been a rough, 7 years, since 2017, and Chinese stocks have been down in 5 out of 6. Chinese stocks have basically been down for 7 straight years, minus a small up year in 2019. It's been really, really ugly. But that's starting to change, and the market is solidly up after double bottoming. See 2 strong double bottoms put in here around the 1500 level in 2023. And we are most excited about domestic consumer plays, so staying as far away from the geopolitics and tariffs as possible. And that's where the stimulus is being directed. So, like Insmed within biotech, even a choppy tape for China the last couple of years, there have been some good companies and stocks to own, like TCOM. And don't look now, but a gauge of Chinese tech shares listed in Hong Kong actually has entered a bull market for the first time in a long, long time, as investors are turning more bullish on Chinese tech again following the DeepSeek announcements. So there's even more upside in things like KWEB, which is the China technology-focused ETF, if you believe Chinese stocks will potentially go back to prior highs over the next couple of years, with KWEB, trading in the low 30s versus a previous high of about $90. So, there's a lot of left for dead things out there. I also think the solar sector, after some consolidation, could be very interesting. But like biotech, lots of upside opportunity and themes to focus on, if, the Hang Seng is going to go up to prior highs and 72% as the chart here shows over the next couple of years. And then, just looking at this final chart here, everybody piled into India, everybody piled into Asia ex-China the last couple of years. I think this could be a classic example of, buying what they wish they would have bought because India has been such a strong performer, selling what they're going to need, that being, China, since China is so out of favor and bombed out here. And you're starting to see a pivot in the technicals and starting to see headlines like, David Tepper continuing to increase his China exposure. He historically has a pretty good nose for things like this and market pivots. And importantly, this is more domestically than foreign flows, but a China 10-year yield is only 1.6%. So, if you look at companies, they've been increasing buybacks, increasing dividends. And, for a lot of companies, the blue chips in particular, the dividend yield plus the earnings yield is really forcing, savers into equities at the expense of real estate, given all the challenges the country, still facing in the property market. So another thing to pay attention to. Then rifle shot shorts. Some great quotes here. Short selling is tempting, but it's ruined a lot of people. Warren Buffett. Being short and seeing a promoter take the stock up is irritating. It's not worth it to have that much irritation in your life. Charlie Munger. And both of those quotes, kind of suggest that you don't do it. And it's hard. And at times it's an occupational hazard. But I actually forget who told me this. Would like to attribute it to whoever did, but I've simply forgot over the years. But I think it might have been someone at Blue Ridge or John Griffin. But the short side, in this industry truly does separate the great from the merely good. And, right now kind of reminds me of, a time when I was kind of a young pup in this industry and had the privilege of, working at 101 Park and, the privilege of attending the once every 2 week investment meeting on the 48th floor, chaired by Julian, legendary investor, one of the best to ever do it. Certainly one of the best to ever do it in terms of finding and seeding talent. Rest in peace. But every 2 weeks he would get his analysts and his managers, the PMs around the table and have them pitch long and short ideas. I wasn't allowed to participate, but I was allowed to observe. And only looking back on it, do I realize what a privilege that was and how much I learned from it. But I just remember back in 2006, 2007, everybody was pitching long ideas. And Julian always says, don't forget about the short side. Don't forget about the short side. And I kind of feel like this is one of those moments again, much like 2021, where everybody is just mesmerized by the bull case, the narrative, and there's a lot of alpha opportunities to be had on the short side. But at the same time, you got to have some rules you follow, and a couple rules that have really stuck with me every time is don't short open into growth stories and mess with the bull and you'll get the horns. So at times you just have to know when to step to the side. But there's a lot of opportunities out there. And one in particular right now where things have just gotten completely out of whack is within the quantum computing stocks. And, a good story can only get you so far. Trees don't grow to the sky, even though these charts might make you think otherwise. And anything to do with quantum computing has really, gone parabolic, since Google's update on its quantum computing efforts last year. But Jensen Huang at NVIDIA and Mark Zuckerberg at Meta have already poured some cold water on this, saying that, yeah, quantum computing is interesting. It's great. We should definitely continue to develop and innovate within that field, but we're decades away from it being useful. And, a lot of the innovation and development is occurring within platforms and firms like Google, with endless CapEx and the best talent out there. So the likely breakthrough technology and innovation within quantum computing from the people we talk to is likely to occur within the Googles and the Microsofts and the Metas of the world versus, some of these science project stocks on the screen here. Yet hope springs eternal. I was just looking at the valuations the other day in prep for this webinar. And if you look at D-Wave, which is the one on the bottom here, has a market cap of 1.3 billion on 9 million of revenues. The last 12 months, they've lost $73 million, and they only have $29 million of cash on the balance sheet. IonQ, which is the blue line, has an $8.5 billion market cap on 38 million of revenues. They've lost 172 million in the trailing 12 months and have only $366 million of cash on the balance sheet. Rigetti Computing, which is the red line here. I'll take a sip of water. I'm losing my voice. But Rigetti Computing, market cap of 3.2 billion on $12 million of revenue and 60 million of losses last 12 months and 93 million of cash on the balance sheet. And then Quantum Computing, which is the pink line here, pink purple, $1.1 billion market cap on $400,000 of revenues and 26 million of losses in the last 12 months with $3 million on its balance sheet. So even if the technology lives up to the hype decades down the road, the dilution along the way could be massive. And I'm guessing the retail investors who have piled into these stocks, or better yet, short-dated options, are not taking that pesky little detail into consideration. So short interest is high in these stocks. Execution will be tricky, but when they break, they're likely going to break hard. So consider yourself warned. And then AI. So hopefully this hook kept everyone around to the end of the call here, but couldn't be more excited about this. And I think this Bill Gates quote kind of encapsulates things for me in that, most people overestimate what they can achieve in 1 year and underestimate what they can achieve in 10 years. And the breakthroughs in AI, here recently, as people have worked really hard on it for the last 5 or so years, are out of this world. And I don't say that with hyperbole. And we've been talking about this, publicly in forums like this for a couple years now. So back on the June 1st webinar, we said AI could be big, like really, really big. And since then, NVIDIA is up 3x. And we showed this chart and the record that ChatGPT broke at the time, and that it only took 2 months for them to reach over 100 million users. And that record has since been smashed. First by Meta's Threads, which I don't think is really fair because they were able to leverage, their multi-billion user base across Facebook, Instagram, and WhatsApp. But it only took 5 days for Threads to get to 100 million users. But I kind of put an asterisk around that one. But more recently, DeepSeek took DeepSeek less than 7 days to reach 100 million users, just to show the viral nature of that launch. And from an opportunity set standpoint, we think that with the development of DeepSeek and things like it, with open source, which we'll talk about here in a minute, really sending a shot across the bow of the closed source players. We think that the opportunity set is really shifting from the infrastructure stage to the application layer phase. And you can see that this is a repeatable playbook. If you look at the mobile internet cycle, a lot of value in the early days was generated by the semiconductors, Qualcomm and ARM, then went to the platforms and infrastructure players like Samsung and Apple. And then later, the software and application and service layer became the big value creator with things like Google and Amazon. If you look at the AI cycle, clearly semiconductors are where you've wanted to be. Also made good money in the hyperscalers. I love how each cycle has different nomenclature and buzzwords. Took me a couple months to realize what hyperscaler meant, but I've now adopted that in my lexicon. But simply an infrastructure platform, a platform, a hyperscaler, within the industry, been a good place to compound capital. But as we've gone from the training of these models phase increasingly to the usage of these models phase, and as the cost of using and creating these models and the compute needed to use them is decreasing, I think the application layer is just going to take off, and all of us are going to see AI agents enter our lives in productive and useful ways later this year in things like customer service and travel, but also on the corporate side as well. Think that the application phase is now investable. Whereas a couple of years ago it was kind of like, we'll see what happens. Like, don't really see the use cases yet. The use cases are around the corner. So looking at this whole open source versus closed source debate, until recently, open source would lag closed source models by about 6 to 12 months, looking at things like quality and speed. But then you had a breakthrough with Llama, which is Meta's LLM 3.1, 405 billion parameter release in mid-2024. And then more recently with the DeepSeek R1 version launched on January. And I really don't think it was a coincidence that it was launched January 1st, which was MLK Day, but more importantly, Inauguration Day. So it took about a week for it to really catch fire. And then this led to the large sell-off in markets as everybody looked to synthesize what had just happened on Monday of the following week. But if you look at the landscape now, this is basically how it lays out. On the open source side, you have NVIDIA with its CUDA software and platform. You have Meta with its open source Llama LLM and DeepSeek. And then some smaller players like Mistral in Europe and Hugging Face. And then on the closed source side, you really have the giant being OpenAI and ChatGPT, also Google and Amazon, and some smaller players like Anthropic, which is backed by Amazon. But I think that DeepSeek and overall open source, will likely be a leader, if not winner, longer term, as it's cheaper, it's more transparent, it attracts more developers, it's more scalable, and I think that the market is quickly starting to recognize that. And just skipping ahead, if you look at the market reaction, since the DeepSeek announcement, NVIDIA's market cap has fallen by about $350 billion, while a basket of winners from open source in terms of data storage and data movement, public companies now that should prove critical as AI apps come to market, that we put together, has gained about 261 billion. Now, NVIDIA still has over a $3 trillion market cap, and NVIDIA, remember, is more focused on training at the moment than inference. And it still has over a $3 trillion market cap, likely to be a big player in the inference market as well. I think the market is now starting to realize the shift and acceleration towards the application phase and layer of the opportunity set. So this basket includes names like Meta, Snowflake, Elastic, Confluent, MongoDB, GitLab, and a few others. But you've seen a big increase in market cap there that has mostly equated to the market cap decrease in NVIDIA. So we think NVIDIA has been kind of donating market cap to some of these players that are more focused on the inference side of the equation. But just going back to DeepSeek for a second, you can see that its quality is in line, and this data is from Artificial Analysis, a third-party independent firm that keeps tabs on the space, on par with ChatGPT, but its speed's a little slow. And that's why you need inference and some of the AI accelerators, some of which we like and support, as you really do need responsiveness measured in the milliseconds for use cases and large market opportunities within things like software copilots, fraud prevention on the gaming side, like immersive gaming and NPC, non-playable characters, emergency response, financial market trading, full self-driving, et cetera, et cetera, et cetera. So I think you're going to see down the road development of an ecosystem that relies on and utilizes these AI accelerators on top of really good quality, but a little bit slower open source models like DeepSeek and Llama. Okay, getting a little long-winded here, so I'll stop there. See if there's any questions. And if there aren't, please enter them in the queue. I mean, we have some managers that see opportunity in China biotech, and I think that's kind of been upended, to be frank, the last couple of years as barriers have been erected between China and the U.S. and a lot of drug development that had been moving over to China has moved back to the U.S. But still seeing a lot of opportunities where drugs are being licensed both ways, both from the U.S. and being commercialized in China, and both from China and being commercialized in the U.S. and elsewhere. Actually, one company we like a lot, won't name it in this forum, but happy to talk about it in a follow-up, has licensed a drug from China we think is really interesting. And the studies for it were actually done outside of China. So we think it's very buttoned up in that respect from a clinical trial basis, and is in the process of being commercialized outside of China in the U.S. and in Europe. So I think it's hard to generalize, and I think there's opportunities within each. And anecdotally, certainly seeing that in terms of opportunities bubbling up from the managers we work with in the fields. All right. Well, I can see the box now. It doesn't look like there's any more questions, but I appreciate your time. I appreciate everybody sticking with me for 45 minutes here. If anything comes to mind after the fact, please feel free to get in touch. And again, happy belated New Year. Best wishes for 2025 overall. I hope it's good year performance-wise for your portfolios, and wishing your families all health and prosperity, and hope everybody has a good long President's Day weekend, and look forward to catching up with you again in a couple months. So take care.